All right. We are here, ready to rock and roll. Hope you guys had a good weekend, long holiday weekend, and now everybody's excited to get back and start to trade, make all kinds of money, be rich, rich, rich beyond your wildest dreams. All right, let's make that happen. Today, we got a very special class involved because I want to teach you something new. We've got a new tool available to us, a new software tool that's going to help us make better trading decisions. And so I'm going to bring that in and let you see what that is. So I'm very excited about that. So we'll just jump right in and make that happen. It's nice to see all you guys in here so quick and early and first thing in the morning. And nice little crowd here already. So that's great. So let's jump right in. The thing I want to do is I want to introduce you to a company called, let me bring it up this way. It's called, what is it called? Portfolio Matrix, PortfolioMatrix.com. Portfolio Matrix. Yes, this is my son's company. This is the software we've been working on for 2 years. And we're finally getting it to the point where we're able to show it to you. All right. So I'm not going to take you in and give you a big grand tour yet. I just want to take you through and start showing you some features that are in the software that we're working on. Can you sign up for this right now? Yes, you can. Are there still some little bit of minor bugs in there? Yes, there are. This is the what he's calling the Founders Edition. So if you want to be part of the Founders Edition, you can sign up early. He will come and help you personally, one-on-one, help you make sure you get everything put into your portfolio matrix and you get running and rolling. The question is, why do I need it? Why do I need a portfolio matrix? You don't need it. Because if you like doing this spreadsheet right here, which I just gave you for free, the new version of the spreadsheet, if you like doing spreadsheets like this, and you'd rather do a spreadsheet like this, which is what I've been doing for the last, year on this channel, showing you how to run this spreadsheet. And we've got like multiple iterations of it. And if you're a subscriber to Pit News Magazine, which all of you should be, Pit News Magazine, what's Pit News Magazine? Oh, you would have to ask. All right, here you go. Pit News Magazine, for those of you who are not aware.
Ready to level up your news game? Welcome to Pit News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pitnews.com. That's pitnews.com. Pit News Magazine. News your way.
All right. So those of you who are not aware of Pit News Magazine, if you go subscribe to that magazine, it's a multimedia magazine. You can listen to the articles. You can come here and watch the articles. This is what we take and we work here in this class on the YouTube channel, and we publish all the articles. So you have all the notes basically in the magazine at the end of the month. So it comes out every month. And then again, it's like a big podcast. You can listen to it. All right. So if you have a subscription to that magazine, well, this spreadsheet comes along with that magazine. So you get the spreadsheet if you would like it. Now, it's a pretty complicated spreadsheet. You have to subscribe to Microsoft Excel, pay for that service so you can have it because it updates the data throughout the day each time you open it, and you get this nice little spreadsheet for you. And it'll help you run this model that we've been running for the last year. Now, this is going to be a multi-class series on understanding this concept, all right? Because I'm going to show you how to use Portfolio Matrix instead of this thing. Now, a lot of people struggle with spreadsheets like this. There's a lot of math in here, a lot of formulas. You have to understand them. If you don't understand how to put together a big spreadsheet like this, you probably might struggle a little bit. Now, I've done most of the hard work, but it's still just a boilerplate for you to put in and plug in all of your stocks, the ones that you're following. And then you can see what kind of money you're making on your stocks. Now, admittedly so, this is not a complete view of everything that I've done in my spreadsheet. Hold on a second. I'm losing my voice. Listen to that already, starting first thing in the morning. Give me 1 second. That's okay. I got my magic lemon water. All right. So this is going to come through. And what I've done here is I've set this up so that you can see all of these different um, totals up in here. So this is your UBI, Universal Basic Income Account deposit. So the initial amount that you put into the market. Now I put initially $448,000 into this portfolio. And then it shows you your dividends that you've received. It adds in the dividends. Then we keep those two separate. So we have our initial deposit, we have our dividends, and then we track those two as two separate investments because we want to see our exponential compounded growth, right? So then we have our total infusion, we have our dividend infusion, total gains invested, we have our stock options currently active, we have our cash withdrawal, how much money we've taken out. I've taken out 107,000. We got cash on hand. This thing says I got about 215,000. I haven't updated that. That's a little bit more than I have. I've already put some of it back in, so it's more like that's pretty. That might be pretty close. And then we got the capital. This is. I'm starting to try and make this look like a business. So I use the terms from a business. So this is capital expenditures, current asset values, and then we got our. Let me close this. This dumb thing keeps popping up. Hide until okay. And then we got total realized capital, 778,000. This is our trading profits, 330,000. And then for the year, this is for the 1 year, 330,000 is what I've made. Now that's not true. And I mentioned this to you guys before. It's not true because I accidentally, not thinking, my brain wasn't all there when I was doing some rebalancing. All right, because I have to manually rebalance my portfolio when we're using the spreadsheet. And I went through and I deleted the ones that I cleared out, and I deleted them out of the spreadsheet, which I should not have done, because now the profits that I made from those that I took out are gone. So these were actually up in the $30,000, $40,000, $50,000. See, right now this shows that in January I made 24,000. That's not true. I made about 50,000. And so this number here, my trading profits, is not correct either, because it's only taken into consideration the ones that I still have open in the spreadsheet. All my closed positions got removed because I wasn't thinking, my brain wasn't all there yet. This is a new spreadsheet, and I was like, oh, I don't need those anymore. I closed them out. So I closed them, realizing that, oh, now all my totals are wrong because it pulled out all my totals. So this shows that I've only got $24,000 in January, $21,000 in February, $23,000 in March. This shows that I only made $46,000 in May. I actually made closer to like, what was it? It was like $70,000 in May, and it only shows 46,000. So my numbers are all wrong because all my closed positions went away. That's one of the advantages of having an actual software program that does this for you instead of the spreadsheet. But I love the spreadsheet. So if you guys love the spreadsheet, it's just going to take me about 20 hours to go and put all that information back in. And when I say 20 hours, I'm not joking. I've literally put hundreds and hundreds of hours into creating this spreadsheet, and I just gave it to you for free. Well, not free. You have to be a subscriber to Pitt News Magazine, which is $39 a year. Wouldn't want to break your bank there, but you get this spreadsheet and a lot of others. We got all kinds of fun stuff in here. All these spreadsheets come with it. Plus many more that are not in this model. There's a couple others. So you get those all when you subscribe to Pitt News Magazine. All right. So anyway, if you like to do spreadsheets, then you don't need Portfolio Matrix. All right. But if you're not big into spreadsheets, and you have to pay the money anyway, I mean, you have to pay a little subscription. It's not free. Portfolio Matrix costs about $25 a month. But it does save you hundreds of hours on your spreadsheet. Now you say, well, why do I even need that? I've got a brokerage firm. Well, if you're just going to do the strategy of buy low, sell high, again, you don't need Portfolio Matrix. I mean, Portfolio Matrix will have a lot of things involved in there that will help you do much better buy low, sell high, but it really is kind of tailored towards people who are doing a universal basic income style of trading, doing our model, which is dividends. And because of the model and the stocks that we're trading, we don't even really call them dividends. We call them distributions, right? We know all about that. So let's log in to Portfolio Matrix, and I want to show you my setup. All right. Now, again, we're kind of not going to go through and show you the entire model at this point, because I'm going to take you in, and I just want to show you some very specific tools within the software. All right. So I have over here in my portfolio, I have my UBI portfolio, which is the one that you just saw me pull up in the spreadsheet. The problem is that you have to have a spreadsheet for every one of these. You have to have my UBI, you have to have one for my Roth, and you have to have one for my traditional IRA. And see how I have each one of these in here. That means I would have to have, and I do, I have a spreadsheet for each one, and you're going to have to maintain each one. So here's my business model one for my individual account. Here's my one for my traditional IRA. Here's my one for my Roth. Here's one for my SEP. Here's one for my HSA. Here's one for my Janice's account, my wife's account. And as you can see, as you go back, they're older and older and older iterations, because you have to have one spreadsheet for each portfolio. I've been trying to think of how could I combine them all into one, and I think I can, but then it doesn't separate them out. So I don't see just Janice's. I see everything all combined into one, into my individual account, into my business model, and it would just have everybody's, all of them in there. So there's advantages and disadvantages, but of course the software takes care of that over here. So you can see the software. Now I'm not going to go through and, but I will. I'll drive down through this real quick. And you can see that in here, you can see I've got my investor breakdown, $773,000 just in my one UBI portfolio. And this is taking into consideration both my, my active current activity as well as my closed out activity, which is the problem I had with my spreadsheet, right? When I pull up my spreadsheet, it doesn't have any of the closed out positions because I didn't archive them. You got to do everything manually with the spreadsheet. Now, I love the view and everything in the spreadsheet and all the numbers and stuff, and I love to go in and do all that because I'm a real math. I'm a computer nerd. I like this kind of stuff, but it's easier if it's just all done for you. Okay. And so you can see my growth right here. This little green line here, this is the growth of my income that's coming in. You can see my trades down here and against my growth. So then that's brought into this window here. This is my return of cash and capital. And when those two come together, those two lines come together, that's when I'm at break even. Everything I put in, they've given me back. And that'll show up in here. And then I've got all my underlying totals. And then, of course, I've got my spreadsheet, which is right in here. You can see my monthly totals. So everything that's coming in December, in January, February, March, April, May, each month, and which stock they were associated with, and the monthly totals. So 30,000, 32,000, 26,000, 27,000. Now that's just my one UBI portfolio. If I click my full portfolio, it'll take all of them. Take my UBI portfolio, my Roth IRA, and my traditional IRA, because those are the ones I have in here, and it will line those out and it'll show them to you right here. So you can see quarterlies, and then you can see running total. So right now, you can see right now, as of September, I have nothing coming in September, but my running total for the month of September is the same as August, because August is my last payouts. I've made so far this year 200. Just in my UBI portfolio, not counting my Roth, not counting my traditional IRA, I made $297,000. All right. So that's how this works. And it's all right here for you. And, the problem with, I'll tell you the biggest problem with this software, you don't have to do anything except for trade. It takes all the fun out of it. You don't have to do your spreadsheet. You don't have to sit there and labor over a spreadsheet for 4 hours a day. You can't tell your spouse, your wife, your husband, you can't, I'm really busy up here. I got to work on my spreadsheet. I got to get this done. I'm managing my money. This just does it all for you. So now you can't, now you don't have that excuse to say, I got to sit in front of my computer for 4 hours a day, updating my portfolio, because it's just done for you. And it draws all the little charts for you, shows you all of your income for you, has it all calculated out for you. It shows you the ranges. It shows you all of your profit and losses, and it charts out each one of your current value, your net value, your cash out, your invested break even, your contributions, your reinvested. This shows you your growth side. This shows you your equity side. Shows them side by side. Yeah, it takes all the fun out of it. You can't go to your spreadsheet and create all these little charts because they're all made for you already. All right. So if that's a thing you like, this is going to be a great little tool for you. And we can go back and just see year to date instead of one full year back. We can change that and come back down here, and then we'll just see what we've done for the year. and it's calculating, and so that'll pull up. But that's not the point that I wanted to show you. There it is. So there we are. Just for the year, we're up 267,000 on the year. All right, starting in January. So you can see that right there. All right. And that's just for my UBI. If I hit on my portfolio, it would show all of them. All right. So now we're going to come in. And what I wanted to show you today, the new tool, is not this. This is really cool, and this is really awesome, and you're going to love it if you don't want to do your big spreadsheet. And you're like, but Lan, I have a brokerage firm. The brokerage firm doesn't calculate stuff the way we need it done right. Now, I'm going to take you back and do this manually first, and then I'm going to show you how Portfolio Matrix does this for you, because I'm going to take you through the exercise that you're familiar with. We'll come over here, and we're going to pick one of these stocks that are in our that's in our portfolio. Let's do Tesla. All right, we're all familiar with Tesla. We're also familiar with PLTY. I've made so much money on PLTY. I'm going to tell you a funny story. I was sitting here the other day, and I was driving down the road, and I saw this guy ahead of me, and he had a funny license plate. You ever seen those funny license plates? Maybe some of you even have them. I've never had one before, but I saw this guy driving down the road, and I was laughing. I was like, oh, he's got such a funny license plate. And then I started thinking, I want a license plate like that. What would I put on my license plate? And I thought, I'm going to put PLTY on my license plate. Why are you going to put PLTY? Well, because I made enough money this year in PLTY to buy this car I'm driving. So I thought, that's a cool idea. So I did. I sent off for my license plate. And so now none of you can take that one because I got it. PLTY is my license plate number now that's on my little TT. How many of you got the Pit News Magazine subscription and saw that funny article I put in there about those kids who tried to interview me? It was a funny article. You guys should watch it. You should go see that article. You haven't seen my article yet? It's a good article in there. Pit News Magazine. You got to go see it. Here, hold on. I got to pull it up just for kicks and variety. We're going to go to Pit News Magazine. Magazines. What is it? It's 2025. What are we on? 9, right? And I should not let you see this because then you get the magazine. What is it? I can't see. You need to go buy the magazine anyway. All right, this is this month's issue of Pit News Magazine. Come on, pull it up. It's being slow. There we go. All right, Grant Thorne. Oh my gosh, I'm so happy with we got Grant Thorne. He's so cool. He's such a good writer. He's our Washington correspondent, and he's very big into tracking down all of these miserable bastards that spend all of our money on themselves and trade in Washington, and he shows you all that stuff. But this is the September issue. That a really good little poem for us this month. Got a fun little game for you to play here. This is a really fun game. You got to guess what the words are, and then you got to go find them. So United Health Meltdown. That's a really good article. This is the one that were Grant Thorne's first article for us. He's already written like 4 articles for us, and because we only publish once a month, he gets one. So we've been doing, Claire's been putting them into her podcast, so you can go listen to his articles in the podcast and also written down here. So this really cool article, a lot of fun if you love conspiracy theories. He's got all kind. He's full of conspiracy theories. All right, and then we got YBit versus Bitto. We talked about that in class, if you remember, and we went down and we did that one. And then we got covered calls, put spreads, and the new frontier and UBI. That's an article I wrote talking about this exact stuff that we're talking about today. And then where's the one I wanted to show you? Here's a full delta, no drama. That's by Aidan Gray. That's a really good article on when to put on your synthetic long positions with a soft stop. And then that's this class that you're in right now. And then here's what is the basis points. That's by Doc Scott Brown. Okay, here we go. How much do you have in your checking account? This is a great little funny article. I had a couple of kids come up to me and they stuck a microphone in my face. I was getting out of my little car. This is my little car. And they were asking me how much money I had in my checking account. And so I started to laugh because then the coach, what is your job? What do you do for a living? And how much do you have in your checking account? You guys have seen this, kids doing this on YouTube all the time. It's kind of the new hot thing, right? I pulled up in my new little Audi TT to a restaurant, and these kids came out and stuck a microphone in my mouth and the face, and they're like, well, how much you have in your checking account, and what do you do for a living? And I thought, oh, I'm going to teach these guys a lesson. I'm not going to play their game. And so I pulled out my key checking account and I showed them, this is how much I have in my checking account, and this is my savings account. $1,242 in my checking account, $1,570. And I said, I'm a school teacher. The kids looked like they just, their whole faces just went, oh, they were wasting our time talking to a stupid school teacher. I said, you know what? Ask the wrong question, get the wrong answer. Because if you'd asked me how much I have, what my monthly income is, I'd have shown you a totally different picture, which is this one here. Monthly income is $51,000 a month. That's a lot of money to me. I don't know, but some guys might not think that's very much, but to me, $51,000 a month is a lot of money. $612,000. That's in my dividends for this year. And so I thought that was really funny because my checking account showed $1,200, and they said, how much, what do you do for a living? I said, I'm a school teacher. And they were so disappointed. They didn't even want to talk to me. They turned off the microphone, turned off the camera, and walked away without saying a word. I said, if you'd asked the right question, if you said, what's your monthly income, I'd have showed you a totally different picture. $51,000 is what I'm sitting on right now. So that brings us back to what this little tool right here is showing us. And the reason I wanted to show you that was because in my spreadsheet, I have all that stuff calculated out, but I have to do it manually, and it takes a lot of work. So we can come over here and we can now do that in our software, which is right here. All right. So, or this one here, I guess, Founders Edition. So this is all done for you. We finally got it to the point where we feel comfortable letting you come and sign up. So you can sign up, and if you do, my son Ben, who is a Series 65 certified financial advisor, he's the one who's put this whole thing together. He not only designed it, developed it, he and I together did a lot of it together, but he mostly is the one. And then, of course, he wrote all the code along with a couple of other programmers. But we've been doing this for 2 years, and this is our new software. We're very proud of it. And so it's designed specifically for people who want to, oh my gosh, I'm losing my voice. It's specifically designed for people who want to run these UBI, Universal Basic Income portfolios, like I've been teaching you, and don't want to do the big spreadsheets. Okay, so he's designed it so that you can do the buy low, sell high. It's a full portfolio designed for everybody. But let's come in, and I want to show you the neat little trick. So we're going to come in here, and we're going to go to. Oh, that was the whole reason I took you over and showed you. I wanted to show you my little car. That little car I've restored, and that's the one I'm putting the PLTY license plate on. I thought that was really funny. I think it's funny. You're so funny, lad. Okay, let's do PLTY then. Little side note there. We have to do the weave, the Donald Trump weave. We have to weave in stories so we can come back, circle back around. All right, so this is, let's get rid of all these things here. So this is PLTY. All right, now we know that it's based on PLTR. PLTR is the underlying stock. Now, I sold out of this one, but I'm looking to get back in. This is an X1SA1. We're coming into an X2SA1, and I'm looking for it to drop down to this lower point. It's falling out the bottom of my little triangle wedge for pattern here, and I'm just looking for it to come back down. The month of September, we talked about this last week, is the most miserable month of them all. If you come into Pitt News Magazine again and you slide down, we got a whole article, The Curse of September, Wall Street's most dangerous month, and then September is historically a very weak month. We talked about that, right? And so here's a nice, beautiful article about it and some trading opportunities to take advantage of that if you're interested in that kind of thing. Okay, and so that's what we're talking about right here, the curse of September. This is coming down off of August, September, or into August and September. So we got July, August, September all drop. Boom, boom, boom. And that's what we've been going through and anticipating, right? And we did in our technical analysis on this over in Track and Trade, and we can pull up PLTR. We're going to eventually get over here. And you can see that this is what we're looking for. All right. So this is the nice little trend line that we got in here. And we're looking for that thing to come out and break out the bottom. It might pop up and hit that blue light right here. And then I think we'll get one more flush. I don't know. All right. I don't know what it's going to do. It's just the models tell us. What has it done in the past? Right. So what have our models told us? So in the past, we've had a nice little 3-drive pattern in here. And this thing's coming up with our full Fibonacci retracement. It came down and look, it touched the 38.2 like a train on rails right there. Just, you would think it was programmed into a computer. Oh, wait, it was. All right, we've talked about it that at great length in this class, and how we can predict most of this stuff. Drive 1, drive 2, drive 3. We get our counter trend ABC. We can predict this stuff because it is programmed into a computer. Most of the big trading with the big firms nowadays are done with computers. They're not done with some guy in Wall Street banging, his finger on a mouse. That's not how it's done. It's all programmed into a computer. And because it is programmed into a computer, we can reverse engineer that and have a pretty good idea of where they're going to push the markets to. Doesn't mean it always works, because there's retail traders involved, and they do sit there and bang the little mouse button, and they can kind of screw things up. But they're also the other side of the big traders' money, so that's how they take your money, right? So we're going to come in here, and this is what I'm looking for in Palantir. I'm looking for Palantir to come back. I want to see one more drop. Doesn't mean it can't rally and come back up. It can, but I think if it does, it'll still come back down one more during the month of September. And then as we come in and round out September, I think we'll come back in and get another opportunity to be into Palantir down in here. And then we'll get the opportunity to buy some Palantir. I can't make any of my buttons work. We'll get Palantir to come up out of here. And that's what I'm looking for. Is it going to happen? I don't know. It could take off right here and go without us, and I would miss out on Palantir again. But I did take my position out of Palantir, so I didn't have to ride down through this. Now, if you didn't and you're riding down through this, there's nothing wrong with that. You're just going to have to sit through a drawdown, and then your dividends that come out of Palantir, which are relatively large, right, are going to pay you, and you'll just stay in. There's nothing wrong with that. You can just stay in. In fact, Ben and I had a big discussion about this, and we've been talking about it at great length, because I'm a trader. I still have the tendency to want to preserve my NAV and the asset value of the underlying stock, and then live off of the dividends. And I feel like, because I'm pretty good at determining when markets are going to rise and fall, spent my whole career doing that, I still want to do that. And he's like, well, for people who are not very good at that, they shouldn't do that with these funds. They should just stay in and ride through the loop. And and I'm going to show you where I did that, because if we come back and we look, and I'm going to take you back over to the software here again in just a second. Actually, where did it go? I want to show you this first. So if you come into oh, I do need to come over here. I wanted to come over, and how do I get there? Oh, it's right here. I wanted to show you. Now I'm getting off on 6 different directions in my head and don't know which one to show you. Okay, let's come in here. I want to show you just let's go back 1 year. And I'm going to show you something on this one. I wasn't going to go into this, but since we're talking about it, let's go in and talk about it a little bit. All right. So come on, there we go. Okay, this is my NAV growth just on my UBI portfolio, not on all the rest of them. So let's collapse all these down. This is just the one we're looking at right here, and you can see this went through for 1 year. So it went through that big dip in the market. So if we come back, go to SPY, that kind of highlights it. Oh, that's not going to show us QQQ. It's going to show us the big dip. So this big thing right here. All right. Now I rode through that. That's a bad, nasty dip. You have to agree. You have to admit, right? That's a bad, nasty dip. And I was trading, and I started trading a lot of these UBI portfolio, or a lot of these UBI stocks right back in here. July is when I kind of went in. September, June, July, August, September. So back in here. So I started like right back in here, and I started buying a lot of these stocks. All right. And so I kind of rode this thing all the way up, and I was feeling smart and like I couldn't be, like I couldn't lose, right? Had that whole euphoric thing going. And then we started going through this little motion through here. Oh my hell. Hold on. Changing of the season. All right. So then we went through this nice little sideways channel, right? You guys all remember this. And we were all like, oh, this thing's getting nasty. And we were trying to decide what we're going to do. And we're counting our 3-drive pattern. And I did take some of our positions off. But as it kept going through, I was worried that this might be a reaccumulation rather than a drop. So I kept a lot of the positions on. And then when it dropped, I was like, oh shit, here it goes. And we got our perfect little ABC off of here, right? So A, B, C, and it went right down to 130.9, just like a train on rails. Speaking of train on rails, in my magazine, did you guys see this? I changed the title. Some of you are going to notice these funny things that I do, but most of you won't. Like a train on rails. Look at that. Right there on the headline. Like a train on rails, straight out of the manual. Here's the manual right here. The stock market playbook of strategy. So when I say like a train on rails, straight out of the manual, here's the manual. All right. Where do you get the manual? It's on Amazon. Just go search Lan H. Turner and you can get the manual. That has all this stuff in there. All right. I thought it was funny. I made up that headline. I thought it was funny. It's funny. We just have fun. We're just having fun. All right. So anyway, this is that dip. Look, this is that big dip right here. Okay. See how that thing comes down, that big dip right there? That's my portfolio. That's what my portfolio did on the growth side. All right. Now remember, this is growth. This is equity. So during the same period, yeah, I did have a loser. And remember, we were sitting through it and I was like, I'm losing money. I'm losing money. But look at the white line. The white line is my invested or break even, and it's going up. And this is going up. See, this is my reinvested amount. This is my combined. So it went flat. I don't know if you can see it very well right here, but you can see that this is my NAV. So everybody's freaking out, right? And this is why I'm telling you, you can't just rely on your brokerage firm numbers because they don't tell you the equity side of the equation. They only show you the growth side of the equation. So when you pull up your little phone and you look at your dividends, or you pull up Track and Trade and you look at how much money you're making or losing, and the brokerage firm tells you, you have your number in there. It says, oh, you're up today or you're down today. If you continually sit there and base all of your decisions on that number, when you're doing this type of trading and this type of UBI portfolio, you're doing it wrong. Because this is what that happened. See this growth right here? This is what happened during that time frame. This was that big drawdown. But that was just my NAV, my net asset value. Look what my actual market did. Yes, the NAV went down, but look, overall, I was making money. The reason I was making money because I was getting those big dividends. The big dividends were actually paying me equal to or greater than what I was losing on the NAV. So I really wasn't losing any money through that whole thing. So Ben and I have been having this big discussion. Should I be buying and selling like I'm doing with my Palantir stock, right? Should I be doing this? Because this is that big, nasty drop right here. And everybody is freaking out. And I didn't even lose any money down it. I mean, I did, right? I lost money. But because of those big dividends that are being paid, it kind of softened that blow. And you can see during that entire time, the reality of it was that I was going flat. And in some months, I actually made money, even though the market was tanking over here on the growth side. The growth side was going straight down, but I was still making money over here, at least not dying too bad, because those big dividends were paying it. And then when it started to recover, well, then we started going right straight back up again, right? So me coming in here and fiddling with it, Ben's like, he's like, Dad, I don't think you should be getting out of the market right here. And I'm like, but Ben, it's going to be drive 1, drive 2, drive 3. It's going to flush, and this market's going to come all the way down to here. Mark my words, we're going to see this market flush all the way back down to this point here. I don't think I should be in the market here. And he goes, well, it didn't hurt you last time right here. And you don't know How many dividends are you going to lose out on waiting for it to come down? Like back here, what if I would have got out during this time frame here? I'd have missed out on 3 big, huge dividend payments across my entire portfolio. And as you can see, my portfolio, I make, well, these are just the active ones. I was making about $50,000 a month, right? $50,000 a month in my portfolio during that time frame. And if I'd have missed out on 3 of them because I was worried that the market was going to fall, so I took them off, I'd have missed out on $75,000 of income during that time frame because I didn't have the perfect timing. I didn't know. I was pretty confident it was going to fall. We'd gone through our full 3-4 drive pattern up here, and the market started going sideways, and I was pretty confident that we were going to get a pullback. I just didn't know where. So in here we got drive 1, we got drive 2, and there it was on drive 3 again. So it dropped on drive 3 across that flat market. And then we got this huge, massive fall in here. And I rode through that. And for the most part, I rode through that. And then we bought a whole bunch down here, and we're sitting here doing the exact same thing. We're happy, happy, happy. We think we're all superheroes. We're making all kinds of money. We're buying license plates with stock symbols on them. We're doing all the same things that we were doing back here during this big rally, right? But now we're sitting through this right here. What are we going to do? Are we going to get out in anticipation of a big fall? Is it going to drop this much? I don't think it is. I think that, well, you never know because there's a lot of political stuff that's going on right now. The courts hate Donald Trump. I mean, they just absolutely despise him because everything he touches turns to gold, right? I mean, he's that guy. And so they really despise him because they want to be in power. And as long as you get somebody who's having such great success, they can't take his power away, right? They can't, there's no reason why you would elect someone else when you got somebody who's doing as well as he is. So they're doing everything they can in the world to thwart him, which unfortunately, that's the way our stupid political system works. You got 2 camps that all hate each other. You want the world to do poorly under the other guy. And that's a bad place to be in. I don't like that. I don't like that everybody, we want the country to fail while it's under Donald Trump. So the court systems, one of the things that's causing our economy to do so well and have such a big GDP is all these deals that he's making, right? He's the deal maker, right? Obama, well, what's he going to do? Wave a magic wand? Well, yeah, he's got a pretty smart magic wand, and he's out there waving it around, and he's bringing trillions of dollars into the U.S. economy. And he's also got these, these trade deals that are going on. And the courts have recently said that they're going to cancel his trade deals, so he can't have these tariffs. They're going to take them away. He's got to close them all down. And so if they do that, well, yeah, this market's going to tank, and it's not going to just go to here. It's going to go to here, right? I mean, this thing is going to die, and that's what they want. They want the economy to do poorly under Donald Trump so that the elections are coming up and say, see, he's terrible. You should vote for us. So I don't know what's going to happen. You got all kinds of things that can happen. Plus, you got the big models from the big institutions who are in here running their BlackRock style quant systems to do their buying as well. So they want it to fall as well. They're going to help pull the rug out from under it so that it can come down. But they do it for a different reason. They do it so that they can buy low, so they can start to load up on positions and get the next rally. So there's a lot of things that are always pulling against each other. So we have to take that into consideration. So again, Ben and I's discussion was, should we just hang on, ride through it, let those big dividends, because as this market gets more volatile, those dividends will get bigger again. They'll start getting bigger because they're based on implied volatility of the options, right? That's how we get these big dividends. And so they pay the bigger dividends. And so if the market's flushing and really hard and falling, well, those dividends are going to get bigger, and they'll help cover the loss of the NAV, the net asset value, right? So if you have another situation where we're going to lose a big bunch of money in the NAV, well, it'll be covered by those big dividends. If you're not trading dividends, well, you're just going to have the big loss. So if you're just holding Apple or Amazon or Netflix or Google or those stocks, well, you're going to experience a huge flush, right? And so sitting through it, then you're going to have to wait for it to come back 6 months later just to get back to break even, and you're not going to have those big dividends helping you, which is one of the advantages of these big dividend funds. So if you rather that, and that's why I would rather, in this case, hold. Let's come over here. Oh, we got so many windows open right now, I can't decide which one to take you to. So rather than holding, if you're just going to hold the Qs, for example, well, we'll just talk about the Qs. A lot of people own the Qs. Well, if you just own the Qs, well, the Qs are going to drop like this. You're going to just lose it. And then how long is it going to take to get your money back? Well, if you have, instead of the Qs, let's say, for example, we're going to do PLTR because we're going to. So if you hold PLTR and PLTR drops, well, it's the same thing because it's PLTR. So if it drops, you're going to lose all that money, and then you're going to have to wait. How long? Maybe, we don't know how long it's going to take for that. Come on, for that market to get back, for that market to come back and bring us back to break even, right? And then start making money again. If you're just holding the underlying stock, that's why we love these high dividend funds, which in case PLTR is PLTY, which is actually just options being traded on the underlying stock of PLTR, right? So PLTYs drop back, but it's paying these huge dividends as it's doing it. So it's helping cover the NAV, which is what's represented in Portfolio Matrix in this chart here. And that you oftentimes don't see. Well, oftentimes you don't see that in your brokerage firm. You don't see that you're being covered, and then they just don't show it to you. They don't show you your combined. They don't show you how that's working. They just show you this one over here. They just show you the growth. That's why that was the original reason why we were going to create this software program. We just wanted this chart right here. We want to be able to see this chart. Now, back to okay, here's the weave again, the weave. We're going to go back over to our manual position. We're going to do it on Palantir again. We're going to go back over to this little tool here, and we're going to go to Palantir, not Palantir. We're going to go to PLTY, right? PLTY, which is our dividend paying fund. And so we're going to come in here, and now we don't really trade this. We don't look at this and say, well, it's down, it's up. Should we buy or sell our PLTY? We totally ignore that because we realize that this is not that type of a chart. This is a holding bank. Think about it as just a bucket of money that they use to draw from to trade options on PLTR. Right? So the bucket goes up and down in value as they trade. As they make money or as they lose money, it goes up and down in value. Now, PLTR is going down in money, right? It's going down in value. So what are they doing? They're selling covered calls, but they also have their synthetic longs. Okay, so they are losing money because of the synthetic longs. That's why it's going down, but they're selling covered calls against it. Well, if they're selling covered calls against it, well, they're not losing money as fast, PLTY. So, but it doesn't mean they don't lose money. They do. This looks like a big drop, but it's from $60 to $80. It's $40. Okay. So that looks like a big drop. And yes, it is. It's a big drop in comparison. All right. To what you've got going on here. But nonetheless, you're getting these big dividends. Look at the dividend that you got paid, $7.49 per share. That's a lot of money. All right. So $7.49 per share. And back here, you were getting $2.56 per share. Well, why the big difference between $2.56 and $7.49? Well, the difference is the implied volatility. So remember, the implied volatility on the options is how they determine how big your dividend is. All right. Now, again, remember, we don't call these aren't real dividends. These are distributions. They just use the dividend system within the stock market to send you your distributions. So they're trading individual stocks or individual options on an individual ETF, a single stock ETF. And they're doing that with options. And so this is just your holding bank. This is just your money that's sitting here. But Lan, it's going down. Yes, it's going down. But look, our dividends went way up. All right. To help you cover that loss as it's going down. Now, I got out. So I didn't get that. Well, I actually did. That was right when I got out. I got the 749 and then boom, the very next day I got out. Okay. So I got out and now I'm sitting on the sidelines. But when that thing pays again, am I going to still be sitting out of the market? That's the question. This was paid on August 14th. So September 14th, they're going to come out with another dividend payment, which is going to be probably close to $7.50 again because of the volatility. Now it's calmed down again. Look, it's just started to go sideways, straight sideways. So I don't know. It might not be that big. All right. But we're going to have a big dividend and I'm out of the market. So am I going to stay out of the market and lose that 7.49 dividend per share opportunity, or am I going to get back in so I can get that dividend? It depends. The market always, not always, but it usually flushes about the distance of the amount of money that you put in. So you're going to lose it on the NAV and you're going to make it on the dividend. I don't know. That's why Ben keeps saying, quit jumping in and out. Just stay in. Because the whole idea is back to this business model that we've built over here in the spreadsheet. You're running it like a business. So it's like a machine. So what happens is you buy this machine for, let's say, $100,000, and every month it gives you $10,000 in revenue, making parts that you sell for $10,000, right? And you're like, okay, is the machine still making me $10,000? Yes, it is. Well, the value of the machine went down to $80,000. So it's still making me $10,000 a month selling whatever widgets it is that it makes. So if you get that mentality in your head, it's like, why would you ever sell the machine if it's still producing money? Well, maybe it's getting slow. It's not producing money fast enough to cover the decay of the value of the underlying machine. Maybe the machine's losing money faster than it's replacing. But if the machine will eventually come back and become valuable again and it start paying big money again, do you really want to just keep selling the machine and stop getting the income? At some point, yes, you might want to do that, where you get a machine that really falls apart. But for the most part, just because the value of the machine goes up and down a little bit doesn't mean that it's going to stop sending you the $10,000 every month. And so that's why I totally redid this spreadsheet, because I wanted to go with that model. I want you to think about each one of these index funds as a machine that's producing an income for you. Roxanne, but the dividends are going down, as is the stock value. On occasion, that's the case, right? That does happen, because as the value goes down, it's a percent gain or increase. But in this case, look, the value went down, Rock. See, it went down here, and it wasn't going down here. See this one? You got $2.56. You got $3.26. Back here, you got $7. And it was going up. Now this one went down. See how this one went down? But yet your dividend went to $7.50. So it's not going down because the stock is going down, and it will a little bit. It's going to take that into consideration because it's part of the math formula, right? But it's all based on implied volatility. So if you go over to track and trade and you pull up on PLTR, you pull up and you pull up an options chain, and you look at an options chain on here. All right. This is what determines right here, implied volatility. This is what determines the can you see it, or am I in the way? Oh no, you can see it. So this is what determines the payout of the dividend, not the up and down of the market. Okay, the up and down of the market will make the implied volatility go up and down, but a market can go down like it's doing now, and the implied volatility will shoot way high. So it's a misnomer to believe that because the market's going down, that the dividend will get smaller. Because if the market goes down slowly, yeah, the dividend will get smaller because implied volatility is not going up. But if implied volatility goes shooting way through the roof, like we've done here, all right, so this market flushed and implied volatility went to the moon, which means that we got a huge dividend, not a smaller dividend. See, so there's an example of how that works. It's back here where the market's going sideways. You got little tiny dividend, $2.56. Well, the market wasn't going down, so you're like, oh, I'm happy. My NAV's not going down, but you got a small dividend because there's no implied volatility. The implied volatility is very small. Well, now the market flushed like a toilet, like this, right? And we got a great big dividend. Why? Because implied volatility shot through the roof, not because the market went down. So the market moving up and down and being active is much more of an influence on the value of the dividend than the fact that the market went down. Because in this case, the market went down and the dividend went way up. All right. So it's not always true to say that, well, the market went down, therefore my dividend's going to go down. That's not true. We can see another example here. Here's $2.98. The market come flushing down and it went to $6. See that? Here's another one, $5. And then out here, this one went to $4. So, and also it's the other way around. Just because the market's going up doesn't mean that the dividends are going up. Now they're going to go up a little bit because of the share price, and that's part of the calculation. But it's, see this, the market's going up. Look, we're only getting $3. $3. But out here, $7. And it's basically the same price, right? It's like around roughly $70 at both of those levels. The PLTY stock, the share price was roughly $70, and we got $3 here, $70. We got $2.93 here, but out here, same $70, we got $7.49, and it's coming down. So that's something to keep in mind. That's a good comment, Rock, because then it gives me the ability, the opportunity to teach you that little lesson right there. So that's the question that Ben and I have been having. All right. Behind the scenes, we've been working through this, and we're like, maybe we shouldn't be pulling our money out of these things at all, which is, now I don't think that's completely the case, because I can show you an example, and I've still not got to the tool that I really came here to show you today. I still want to show you one more tool, but that's because we come in here and we see let's go do the math. I think that'll show it to you better. What I want to do is I want to show you this little tool right here. So we're going to come back into here, and we're going to go into, I think it's this one. So I'm going to pull up this little tool right here, and I want to show you something. Oh, before we do that, I want to show you, we're going to come over and do it this way. All right. So what we're going to do is we're going to calculate. Let's use Rock's example. We're going to come in here and we're going to calculate our share price. Let's say we're going to put $10,000. Okay. So we're going to take our little calculator, and we've all done this math a million times, right, in this class. So we're going to take our little calculator, and we're going to say we're going to take $10,000 and invest it into PLTY. So $10,000, and then we're going to divide that by the current share price, $60.61, 60.61. So that gives us 164. So now we have 164 shares. All right, that's how many shares we can get with $10,000. Now remember, they pay you your dividends, your distributions on the number of shares you own, not what you paid for them. They don't care how much you paid for them. It's irrelevant. You want to pay as little for them as you possibly can. That's the goal, right? Pay as little for them as you possibly can. That's why when we get the dips, we get the pullbacks, we want to start entering dollar cost averaging in, getting our positions in. We don't want to build upside down pyramids. We've talked about that at great length in this class, about how to build upside right pyramids. And I think it's very important to still take that same concept into consideration when we're doing this, which is why I have a tendency to want to buy and sell. All right, the underlying asset. This is being in question right now, whether that's the wisest decision. We've only got a year of data, so we can run our models back and forward. And in the mathematical models, Ben and I have been doing that. The argument is maybe you shouldn't be buying and selling these. You should just be putting your money in here and letting those guys trade the options with it and quit jumping in and out. I've said that a lot, but my technical analysis spidey senses, pop up on the back of my neck when I start seeing a market get into that third drive pattern, and I want to sell. I want to get out. I don't want to ride through this big downtrend. Well, Land, you rode through that big downtrend back here, and it didn't hurt you. It didn't hurt you very badly. It's not that it didn't hurt you. It certainly did. You lost money, but your dividends, because the implied volatility shot way up, covered all those losses. Yes, but it was just a break even. What if I'd have just got out, but then you'd have missed those dividends? Yes, but then as Rock says, you're losing it in the NAV on the way down. That's true. That's why I got out up here. because I might miss a dividend or two, but my NAV is coming down. The question is, am I good enough at timing this to say, okay, now I'm going to miss a dividend because my NAV is coming down, and I don't want my dividend to just pay the loss on the NAV. And so I'm going to be able to time this. I know I'm going to be able to time this and get back in and get my next dividend and my NAV. That's the question. How good are you at doing that? If you're not very good at it, I think I'm probably one of the best. I'm not bragging, but I'm pretty darn good at picking these tops and bottoms. All right. But I still not that good. Even with as good as I am, I still wonder if I would be better off not getting out and just letting these dividends come in. I don't know. I don't know. We've only got a year of data. These are brand new. So that's the argument that's going on right now. Ben, he's not getting out. He saw me get out of this, and he's like, I'm not getting out. I'm just going to stay in. I don't want to miss a dividend payment. And if the market goes down, my NAV goes down, the dividend will basically cover the loss, and I can still buy back in anyway. Then I'll have this dividend, and I can buy back in. I'm not going to have to rebuy my shares at some point. You could do it either way. You know, I don't think there's a right or wrong answer at this point. So let's come back to our example. So now we got 164 shares, and we got paid $7.49 per share. So times $7.49 equals, so we got paid $1,235. So in that month, we got paid $1,735. The question that Rock is asking, which is a good question, it's the question Ben and I are fighting over here too. How much was this? If we were coming in and we had, in this case, let's go to our preferences, and we're going to change that over to, how many shares did we have? 164. 164. So if that was 164 shares, that was a $5,000 drop on our 164 shares, but not really, because that's over in PLTR. We're in PLTY. So now we have to go over to PLTY and do the same thing. How big was this drop in PLTY? And we had 164 shares. So we go to preferences, 164. That was a $2,000 drop. So we made, in 1 month, we made $1,200, and we lost $2,200. So we lost half the amount that everybody else lost. And in fact, if we're over here, so it's not that you don't lose money, but it's comparatively how much would you have lost had you been in PLTR Direct. If you were in PLTR Direct and you had 164 shares, you'd have lost $5,158, and you'd have had no dividend to help you cover that. You'd have just lost $5,000 straight up. So the biggest problem, Rock, that people are having is they're saying, oh, well, you lost money because you were in PLTY. Yeah, well, sure, the market went down. Everybody lost money. If you were in PLTR, you lost money too, but you lost a lot more money with the same investment, 164 shares, $5,158. Yes, but land 164 shares, that's $5,000. I didn't have, for the same amount of money, I wouldn't have had 164 shares. So you'd have to do that math and see where that comes out. The thing is that people forget. They're saying, well, you're in your PLTY and the market went down and you lost money. I'm saying, yes, but if you were in PLTR and the market went down, you'd have lost money too. And what you're not taking into consideration, the PLTR does not have a dividend to help you cover that loss. So you just have to ride through it and wait for it to come back 3-4 months. But what happens in PLTY during that 3 or 4 months while you're waiting for PLTR to come back to break even? You're getting dividends. You're getting dividends. You're getting dividends. So now I got 3, maybe 4 dividends in the same amount of time that you're waiting for PLTR to come back to get you to break even. Well, PLTY has now paid me 3-4 dividends, and I'm back to break even already. In fact, I'd be back to break even at this rate in 2 dividends. Right? And if it takes off and goes up, and you're like, well, yeah, but what if Palantir takes off and goes up? I'll be back to break even in 1 month. True. But then so will I. over here in PLTY, and I'll have 2 dividends. So I'll still be ahead of you. Now, it's all speculative. You never know exactly what's going to happen, but we do have a little spreadsheet over here, and you've seen, not this one here, you've seen my little calculator in here, and we can come into the break-even calculator, and that's what this does here. So we can come in and we can pull up PLTY. Now I got some errors in here, but this is still working. PL is PLT. Where's PLTY? PLTR right there. Okay, so this is PLTR, and this is your break even. So if, let's say the red line is PLTR right here. So if it's sitting flat, PLTY, this is if we reinvest, this is if you just take the cash out. So if PLTR makes nothing from the start to the end, 12 months, makes absolutely nothing across a straight board, well, PLTY will still make a bunch of money. Why? Because of the dividends. And let's say that PLTR makes 50%. Well, PLTY is going to make that 50% plus the dividends. So the reinvested is the green line, the purple line, the blue line is here. So I need to actually extend the calculator beyond 50% and find out where PLTR without dividends and growth only will outperform PLTY. Because at 50% growth on PLTY, it's still not going to outperform PLTR would have to grow. That's a 50% growth on PLTR. And it's still not going to outperform PLTY with cash out alone. And then if you reinvest, this is based on dripping, which I'm not a fan of. PLTY drip is going to make a hell of a lot more money than PLTR all by itself. You can do the math. It's all done for you. I've done it all. I've created little mathematical models for you. So you've gone through that. Now I've got a lot of, Ben will show you, my son will show you his example with Misty. Because with Misty, he bought it. If you come back to the very beginning, this is where Ben bought Pia. This is where Ben bought Misty. He'll show you. He'll come in here and say, look, MSTY. He bought Misty right here. Literally, he could not have bought it at a worse time. He bought it literally at that peak on that day, right there. He bought it right there. I can't draw with this shitty website tool. So he bought it right there at that very, very peak. And then he'll show you. He'll pull up his he'll pull up his portfolio matrix, and he'll show you that he's actually made money this whole time. His NAV is down, but he's made money all the way through that whole thing because the dividends have been, implied volatility on this thing has been so crazy. He's been making money all the way down this whole thing. He's still, when he comes over to his NAV goes this direction, but his equity goes this way. Not as fast. And there's times where it went faster up than down, but he hasn't lost any money. And it's funny because he'll show you, he'll take you in and he'll show you the exact spot that he bought it, which is right there. Bought it at the absolute worst time, and he put a bunch of money in it. And he's ridden it. He hasn't taken it out. That's why he's telling me, he's like, Dad, I think we've got models. We've got history on this thing. I know it's only a year, but we got your history. We got my history. We've got the charts are showing us you're better off not to sell these no matter what. I will show you that there is an exception to that rule. Now, if we come back over to the Pit News calculator and we go back into the investment calculator and we put $10,000 in here, I have to do this because I can't remember the stock symbol. It was MRNY. Look at MRNY right there. It's one of the top. It's very high risk, but it's showing a yield of 102%. And I think this is a good one to use the new tool that I'm trying to, tool that I haven't even showed you yet. But I think that this is a good example. So mRNA is the underlying stock. So we all know mRNA, Moderna. These guys are the ones who made the jab, right? So we got the jab, and of course this was at the peak of their money-making time. And then this is where the market flushed down like a toilet. Now notice that they have no dividends down here. Now they've had some pretty good earnings in here, believe it or not, down in here. But we all know there was an article in Pitt News Magazine about this. Kennedy took away their big contract because he's like, I don't like what you guys do. And so he took the contract away. And so they were going up, and then he took a contract away, and they've gone straight down. Now I want to show you something. I want to take this over and show you mRNY, which is the high dividend version of this. And it's just, the NAV has just gone straight down along with the stock itself. So I'm still of the opinion that you should be buying stocks that have a NAV that rises. Obviously, if markets go down, we're going to lose money. Okay, we're just not going to lose it as fast as if you were in the underlying stock without the dividends. That's the point. Okay, so you can see that the dividends on these are very small, but you're talking about stocks at only $2 stock. So the dividend is actually very high. These are really high dividends, 20 cents. That's 9 cents. See, it's going down. 12 cents, 12 cents. But when you go look at the little calculator right here, it's really high. It's like 102% on the yield. But because it's dropping, the market is dropping faster than even the yield can keep up. Now, if this market would ever turn around and you are sitting here buying all these shares at this low price, right? You'd be building yourself up a dollar cost average position that when that market started to go back up again, you'd be rich beyond your wildest dreams, and the dividends would get bigger, and you'd be making all kinds of money. And I tried that. I tried it through this spot right here where I thought the market was going to start to go back up, right? And it didn't. And then Kennedy came out and it flushed, so I took it back out. Now, that said, we're sitting here doing all this math with our little tiny calculator, and we don't have any history, right? All we've got is just one number. We got the one number of what we're looking at that one time, right? To do this, we would have to go back and we'd have to do the mathematical calculation all the way back across to get each one of these calculated to find out where it was at that point. But that's not going to show us a chart. It's just going to show us that one number isolated. This is where it's cool. So we come in here. Where was I? Right here. And I'm going to pull this up and I'm going to show you mRNY. All right. This is the little tool I wanted to show you. This is actually the tool I meant to show you. It took us this long to get to here. Okay. So now look at this little thing. This charts both the NAV, the net asset value of the underlying stock, against the dividend, the drip. Okay. Now this is dripping. Again, you guys all know I'm not fond of dripping. Why are you not fond of dripping, Lan? The reason I'm not fond of dripping is only because it's not that I don't want you to put your money back in. It's that I don't want you to put your money back in immediately, right back into the exact same damn thing you just took it out of. Doesn't make sense. Why would you just turn around and put it right back into the same thing you just pulled it out of? All right. Because of distribution, that's what they're doing. Oh, you got this money. What are you going to do with it? Well, I'm going to take it out. What are you going to do with it if you take it out? Well, I'm going to put it right back in. What's the point? Don't take it out in the first place. All right. But they're going to take it out, and then you're just going to shove it right back into the same damn thing you just pulled it out of. Don't do that. It's dumb. Okay. If they're going to give you the distribution, I want you to then look at that market and say, is that the best place I should be putting it back into? Or are there 6 other stocks that I've got in my portfolio that might be a better buy? Oh, I can take this money. I don't have to drip it back into the same damn thing I just pulled it out of. I can put it into something else that might be a better purchase. I might be dollar cost averaging into something else, building a better portfolio. If I just think a little bit in my own brain, oh, well, that's a good idea. That's why I don't like dripping, because I want you to be smart about your reinvestments. I want every time you get a distribution out, I want you to think about where the best place to put that money back in is, and just to throw it back into the same damn market that you just pulled it out of. Is that the best idea? Now, you might determine that it is. You might say, oh, I just pulled it out of this market. I've looked at my other 6 markets. Yeah, that's where I want it. Okay, well then go ahead and put it back in. Just don't drip automatically and have the computer just, it's throwing it back into the same damn place I just took it out of. That's the stupidest thing I ever heard in my life. I don't know why anybody would do that. I'll tell you why somebody would do it, and here's the reason why. Because they're trading AT&T. And AT&T also has dividends. And you could just throw it right back in there, because the dividends they give you are what I call why bother dividends. It's like, what's the point? Right. Oh, they gave me 3 pennies. Okay, what are you going to do with it? It's not even worth my time to worry about it. And AT&T is one of the best dividend stocks you can get. And you can see it's got a yield of 4.69% in 1 year. So why bother? You can go get that. You can go get better than that, or about that. That's what you can get. And this is the best one. AT&T is one of the best dividend stocks in the entire stock market. You can about go get that a bank CD. Well, I'm also getting the growth, Lan. I know. Growth plus yield, you're getting 48%. That's pretty damn good. But are you going to trade AT&T to get your 4% dividend when you could be in Palantir and get 400% on your NAV? You're going to sacrifice being in something like Palantir so that you can come over here and get your 4% dividend. Oh, it's a dividend stock. Oh, that's great. If you're trading stocks for NAV, go trade stocks for NAV. That's my point. It's just my opinion. I'm not telling you what to do. I'm just telling you what I do and the way I think about things. And you might think about things differently. That's fine. If you think AT&T is the best place to have your money and for the best growth so that you can get that yield, that little 4% dividend, go ahead. Do that. Because we do it the opposite. I mean, there's an argument to say, well, I'd rather be in AT&T than in PLTY. Well, pull up PLTY, Land. Let's take a look at it and see if your little PLTY is any better than AT&T. PLTY. It's a different mentality. It's a different thought, isn't it? Okay. It's 93% gain. And it's all in the yield, not in the gain. It's not in the NAV. The NAV only made 17%, which is still better than AT&T's 4%. So if you're going to reverse those, right? Say, well, I'm more interested in NAV, or I'm more interested in dividends. Which are you more interested in? Would you rather have a bigger NAV or a bigger dividend? I would rather have the bigger dividend. So the dividend on here, the yield you can see is 75%, but the gain is only 17%. So our stock, we bought it. And your little phone in your brokerage firm, it only shows you this. This is all it shows you. That's why we had to create Portfolio Matrix, because it doesn't show you in your brokerage account. It doesn't show you this number right here, which is the bigger number. They don't even show it to you. It's not even there. Go look. It's not there. It's not there. This is the only number they show you right here. Why? Because that's all they've ever shown you. That's the way we've always cut the ham. Grandma cut the ham like that. That's the way we want to cut the ham. But there's no ways to cut the ham. You can cut the ham and get this number. Well, we don't do that. Why? Grandma didn't do it. We'll be fine without it. We don't need it. Well, we want it because nowadays, I mean, sure, back when dividends, where why bother dividends? Who cared? You don't need to see it. We'll just throw it in the cash. All right. Who cares about that little puny dividend anyway? We'll add it into the cash. You'll just drip it back in anyway. Who cares? Well, now we care. Why? Because we got stocks. We got single stock ETFs being traded with options where the dividend is the income, not the NAV. All right. The dividend is the income, no longer the NAV. So now we can come in here and look at this. Now we can see where the income is. It's in the dividend. It's not in the NAV. See, the little blue line is the NAV. What'd you make? 17%. That's not bad. I mean, but if If you were making 17% in the stock market in your dividend, in your NAV, you'd probably be a little bit disappointed. I bought Apple last year and I only made 17% on my return. You might be happy with that. A lot of people would be very happy with that. They'd be like, oh, 17%. The S&P 500 average is 10%. The Q's average 12, 14%. Okay, well, I made 17%. Well, I'm happy with that. Oh, you should be. Yeah, oh, great. Well, with this little thing, if you combine the NAV and the yield, which is the dividends from trading options, again, this is options premium, you get a 93% return. I like 93% return. That's pretty good money. All right. Pretty good money, 93% return. That's combining your yield with your gain. So yeah, your gain's not as big. Now let's go look at something else. Let's go look at Tesla, TSL. Let's go TSLY. Well, let's go look at TSLA first. We're going to go look at TSLA. TSLA doesn't have any yield. Zero yield. Why? Because they don't give dividends. It's only growth. Yeah, but look, Lan, if you'd have bought, the gain was 58%. Yes, it was. From this point right here to that point right there was 58%. But you had to ride through this nasty thing to get it. Right? It's all over the place. Scare the living bejesus out of you, as they say, right? That's just straight up gain. No dividends. At least AT&T gives you 4%. Right? Let's go look at Apple. Show you Apple. Excuse me. Apple. They give you a dividend, 0.46%. Woo-hoo-hoo-hoo! We're with Apple. We all love Apple. Oh, Apple's the greatest, right? You guys all know I hate Apple as a company. I mean, I like their little iPhone. I got one. But as a company, I think they suck. You know, the gain last year was 4%. And they gave you a 0.46% dividend. Whoa, aren't they great? Oh, we're giving a dividend. Oh, thank you very much, Apple, for giving us a dividend. Oh, and you know what else they did? Pull up Apple, worthless company. This is Apple. And so Apple, you know what they did? They've been buying back their shares. Look at that. Shares outstanding, down. And for the last 4 years, they haven't made any money. No money in the last 4 years. Earnings per share is, look at this. Earnings per share has stayed almost exactly the same for 4 years. How can they have earnings per share at maintaining the same earnings per share if their sales have not gone up and it's because their number of outstanding shares has gone down? So this is fake. These numbers here, these are fake numbers. Fake. You know why they're fake? Because they're buying back their shares and they're not making any money. How can the shares go up or even just stay where they're at if they're not making any money? And how can the earnings per share stay the same? Well, because they're buying back their shares. So they're telling you, oh, well, we buy back our shares. That's good for you. That keeps your stock up. We're giving you back cash because we have so much cash. Oh, well, of course it is. It's because they're not making any sales. It's a lie. It's a lie. They're buying back their shares because they are not making any sales. That's what's keeping their earnings per share propped up. It's all a facade, and it's about to tumble down like a box of cards, like a house of cards. This company is in trouble. That's what that tells me. This company is in trouble. And their share price is only up there because they're propping it up. How long can they keep buying back their shares to maintain that stock up there? They got to eventually start making some money. This company's in trouble. I do not like Apple. Now, why are they in trouble? Because they're not participating in the AI race. They've done absolutely nothing. They failed at every turn with the AI stuff. They tried to do an electric car. They failed. They tried to do the everything they've done has failed except for their little iPhone. It's the only thing that works. And then they sell some laptops too, and their little desktops, but everything else they've done's failed. They need to come up with something. They need to be innovative. They need to do something. That's my Apple. We shut up about Apple. They're a worthless company. All right, let's go back over to, I know you all love Apple, and I'm here. Everybody loves Apple. It used to be the darling of the industry, but it's not anymore. All right, it's getting its butt kicked, handed to it. All right, it's getting its ass handed to them. Okay, so let's come in here. I wanted to show you. What was the one? I forgot the symbol for it. Doggone it. MRNY. I want to show you MRNY. Look at this. This is such a cool little tool because you can't find this chart anywhere else in the whole world. It doesn't exist. MRNY. MRNY. Come on. Pull up. What do we do? Now I've lost my connection. There it is. Look at this. Now, when I bought MRNY, I didn't have this chart. And so I was doing it like we've been doing all of our purchases of stocks. We've been coming in here and we've been doing the math one at a time with our little calculators. And we've been doing the technical analysis over here. Man, I'm sorry, I'm losing my. And so this is why, I started buying in here, but I'd start buying in here based on technical analysis of MRNY, right? MRNY. And actually not MRNY. Look at that. mRNA. So right in here, I bought some mRNA, thinking that this thing was going to make some good returns for us. And it didn't. It flushed right back down. Yes, it's paying big dividends. It is paying big dividends, but they're not big enough to cover the loss. So look at this. That's really rare to see in a yield max fund. To see that number right there. So you can see the yield, which is 76%, which is good, right? Which is what puts it at the top of this calculator list. MRNY, 102%. This little calculator, as good as it is and as wonderful as we thought it was, until we got this chart right here, we didn't know. We didn't know. We were just coming in here and saying, hey, you know what? Big returns. Tesla, 140. I'm going to put my money in that one. Wow, that's going to do us really well. Is it? Is it? MRNY is right at the top of the list, 102%. It's number 3 on the top of the list. But yet, we know from this chart, that's not good. So if we don't have the two numbers, we're flying blind. And so for the last year and a half, the last almost 2 years, well, I guess not 2 years. I've been trading this since July of last year, and it's August now. So July, August, September, a year and 3 months. Right? A year and 3 months. I've been trading these markets, and I've done pretty good. I can't complain. I can't complain. $328,000. That's not including. I'm actually making more than that because I'm guesstimated. That's just with the open positions, and I closed some out, remember? But this is saying that not counting the ones that are closed, I'm estimated to make $402,000 this year. That's pretty good money. And that's reaffirmed over here in this portfolio right here, right? This little portfolio, which is connected directly to. So when you sign up for Pit News or for Portfolio Matrix, you go in and you, the very first thing you do is you say new account and you sync your accounts with your active. So if you're with Robinhood, for example, you would go in and you say, my brokerage firm is Robinhood. How does the information get in here? You don't put it in manually like you do with the spreadsheet. It goes over and connects to Robinhood and it pulls the information in here, and then it does all this math for you on your Robinhood account. So you can't You can't jinx it. You can't cheat. I can't come in here and say, "Oh, I'm going to lie to all my people on Facebook or on YouTube and show them a fake account." I can't. It's not possible. It's pulling all this information from my real money accounts, and there's no. He doesn't have a demo version. It can't go in and it hooks to your account or it doesn't. Either you got numbers or you don't. And so when you hook in there, you just hook it to your account. It does all kinds of accounts. It does fidelity and all kinds of other things. So you can hook it in there. But I would double check with him before you sign up, because it doesn't do everything. It hooks up through something called, I think it's called Square, or anyway, there's some program that does all of the secret math so that it's safe and secure, that kind of stuff. So that's all taken care of for you behind the scenes, and it just gives you a window into your portfolio and does all this really cool math on it. All right, so let's go and look at Tesla, TSLA. So the point that I wanted, we can look at Tesla. Tesla without because it's got no dividends, so it was 58%. We saw that. So let's go look at TSLY. TSLY. And does it outdo? Nope, it does 42%. Okay, so your dividends, so you'd have been better off, and this is pretty common across the board with most of these individual stocks that are growth stocks. If you would have been in the underlying stock, you would have probably made more money than if you're in the dividend stock. And that's pretty common. We all know that. But we're not, those are growth only. So they're not giving you a monthly dividend. So we've done this math before. You're like, well, then why wouldn't I just go buy Tesla? Well, because it doesn't give you a monthly income. You're like, but I can get a monthly income out of Tesla. How? Oh, thank you. My dear sweet wife is bringing me some hot tea so that I can not cough all the time. Thank you very much. And so, how do you take a profit out of Tesla? You have to sell your shares. And if you sell your shares, you're not going to get the 42% return because you sold your shares, right? Or at least the dollar amount of your 42% is going to be a lot less. So the TSL, this is TSLY. So you're getting 42%. Tesla was like 50 or something, right? 50%. So you could have made more money holding the same amount of money through the same period of time under Tesla. And we all know that. That's common knowledge. I'm not trying to say that these outperform the underlying stock. Sometimes they do. Usually they don't. All right. Especially if it's a growth stock. I mean, if it's growing and it's making 200%, 300%, 400%, like some of these stocks do, it's going to be you'll made more money doing that. But to take an income out of these, like some of us guys want to do, I have to live off my money. I want to take money out. Well, I'm going to have to, if I'm in Tesla, I'm going to have to start selling my shares off. And before long, I don't have any shares left and I run out of money. That's the biggest fear everyone has going into retirement, right? Is that they're going to run out of money. And I use Bill Gates as the example. How much ownership does Bill Gates have of Microsoft? How much does he own? He owns 1%. That's all he's got left. Bill Gates owns 1% of Microsoft. Why? Because to get the money out, he had to sell it. He had to sell his shares. And once you sell your shares, you no longer have any shares left. And sure, they may have grown 42% this year, but if you only have one share compared to his 100 shares when he started, right? Not making the same amount of money. He's running out of money. Now, I don't feel sorry for Bill Gates. He's got plenty, and he's put it other places. But when you and I start thinking about that model, right? And Microsoft does give a dividend. Not very big, but it gives a dividend. 0.75. So Microsoft with its dividend, you can see the dividend line in there. It's kind of hard. You guys might not be able to see it. It's a little tiny purple line. It's almost invisible right there because it's underneath the darker blue line. But you can see that's 24% return on your money. Now, there is a 24%. So let's go look MSF. Is it MSFY? Yield max. Oh, that's the curve yield premium. That's not the same one. What's Microsoft's? MSF. Where's MF? I know we got one. MSFT, MSF. What's the Microsoft version for this? MSFO. All right, let's come back in and put MSFO. MSFO. MSFO was 19%. So there again, you would have been better off being in Microsoft over the year to get a little bit higher return, but it wouldn't be giving you money, right? Now, you have to take that into consideration because remember, linear growth versus compounded growth, right? So we're going to take money out, which is going to be our yield of 31%, which is more than Microsoft is getting. Now, this Microsoft actually, this MSFO actually lost money, 11% in that time period because of this big drop, right? Hasn't quite recovered all the way back. But because of the dividends, right, you covered your entire loss with 31% dividends. So you're 19%. But with that 31% dividend return, what were you able to do? You're able to take that money, put it back in, either into Microsoft or into something else, right? And now you'll be able to get that exponential growth. Now your free money is making free money. And that free money is making free money. And that money is making free money. And that free money is making free money. And that free money is making free money. So that's how you get your exponential compounded growth that you're not going to get in the Microsoft stock itself because you're linear growth. That's why you can go in and you can buy a 401k when you're 20 years old. You become a firefighter, a school teacher, a police officer, whatever, and you start adding money into your 401k. And when you're 65 years old, you pull it out and you got $130,000. And you're like, well, I thought I was supposed to have $50 million in there because of exponential compounded growth. Doesn't happen that way. Why? Because you didn't get exponential compounded growth. Why? Because you bought shares and those shares grew in value, but they didn't compound. Right? That's like saying, well, I bought a house, land. In 30 years, how come I don't have 30 houses? Because you didn't compound it. You linear growth. Your house grew linearly. You bought your house, $100,000 when you bought it. When in 30 years, it's worth $400,000, but you still only have one house. If you want compounded exponential growth, you have to buy and sell houses. You have to flip them. You have to buy this house, and then you have to sell it for more than you bought it for, take the profit, buy another house. Sell that house, taking the profit, buy another house. Take that profit, sell it, buy another house. Then you have, at the end of when you're 65 years old, you now have 50 houses. That's called exponential compounded growth. And then you can do the same thing in the stock market, but you can also do the linear growth in the stock market, which is what most people do, which is not exponential compounded growth. One of the 7 wonders of the world is exponential compounded growth, and 90% of the people in the stock market are not participating in exponential compounded growth. They think they are, but they're not. They're participating in linear growth. And they're missing out on one of the 7 wonders of the world. That's what this market gives us. And that's why I love these yield max funds, because they take the profit every month. They take the profit out. It's like rent. Think about you buy a house and you get rent. All right. That house produces an income for you. You now take that rent and buy more houses. You take that rent and buy more houses. Now, when you're 50 years old, 60, 70 years old, you have 50 houses because you exponentially compounded your growth. That's what dividends are. And yes, you can exponentially compound your growth with dividends if you buy the Microsoft stock and they pay you the dividend. But the dividend is so small. And if you're just dripping it right back in again, it almost just disappears. It's so tiny. You could still do the same thing with Microsoft and AT&T and all those things that pay dividends, like we're doing here with the same model. But you'd be making money for your grandkids, not for yourself. your grandkids would be the ones you're making money for to make them rich, not you. I would like to be rich myself, If you want to make your grandkids rich, that's okay too. Because the dividend is so tiny on those that it's going to take 3-4 generations before it becomes a sizable amount of money, unless you've got a sizable amount of money. Now, granted, if you got $10 million already, sure, go ahead, knock yourself out, right? Put it into Microsoft, live off their 4% dividend. It's okay. 4% of $10 million, a lot of money. You could probably do that. But if you're like me and you don't have $10 million, or at least not $10 million that you can invest in the stock market, it might be tied up in other places, right? Even if you got $10 million, right? It's not in the stock market, so it's probably somewhere else, probably in real estate, growing linearly. Oh, man, it's all one big mess. All right. Let's go look at Misty, M-S-T-Y. Look at that. Look at that baby. Even with all the downtrends, Rock, that baby is returning 86% return, which is why Ben can pull that thing up and show you that I bought at the absolute worst time that I possibly could. There is not a more worse time that you could have bought Misty than what he bought it at. Now, I bought it back here. I bought Misty down in this region here. He bought it right there at the peak, literally at the peak, and he's still making money. Still making money. Why? Because the dividend is so high, it's outperforming. Look, the dividend is 115%. Even though we're losing 30% in the NAV. If all you look at is your little iPhone and your little Robinhood app, and it says you lost 29%, you're like, oh, Len, I hate you. You suck. This is the worst idea in the whole world. Well, it's because you're not doing your spreadsheet. I tell you, you got to do your spreadsheet. If you don't do your spreadsheet, you don't know this number here. You don't know that you're making 86% return on your money because you're not doing your damn spreadsheet. And then you yell at me, oh, man, you're stupid. I watched this other guy on YouTube and he told me I was smart because I do what he does, not what you do. Well, he's stupid too. Sorry. Half the guys on YouTube don't know this stuff. It took me and Ben a year to figure it out. And we're the smartest sons of bitches there are on the YouTubes. If you don't believe us, just ask us. We'll tell you. Do we know everything? Do we have all the answers? No, we don't. We're just trying to figure this out with you guys. We're just telling you what we're trying to figure out ourselves, because we're not here to try to sell you anything. We're here to try and just show you what we're doing. Now, yeah, we're going to try to sell you Pit News Magazine for $39 a year. Going to rob you blind. And this little program here, this little program here is hugely valuable. I mean, can you imagine what we're going to be able to do now without having to shoot in the dark like we've been doing for the last year? Now we've got this thing. And I've done the work for you. I've gone through and I've done all these out. So this is what I'll end the video on. I've gone through all of our Yield Max funds. I don't got anybody else to talk to, Rock. I'm the only one here. All right, so let's come in here. Let's go over to Track and Trade because that's the program. Oh, here it is. How do I get over there? There we go. All right, so my UBI portfolio. I've already gone through and I've done all the work for you guys. You're welcome. I've gone through this little program in here, and I've gone down through the Yield Max funds and the Yield Boost funds. Oh, I wanted to show you the Yield Boost fund. So if we come in here and we go, what is it? It's TSYY. This one is kind of, I'm not sure. I was really excited about these TSYY funds, these Yield Boost funds. And now we got this little program. I'm not so sure. I wrote an article in Pit News Magazine hailing them, saying, oh, these things are great. But now that we got this little program, I'm looking at them like, I don't know if they are or not. Look at this. This is really cool. I mean, you're getting 87% return on the dividend, which is really high. That's good. But the NAV just can't keep up with it. I mean, overall, it's a 21% return, which is a good return. I mean, you can't complain about 21%. But it's not like Palantir or Tesla or Misty or any of these others, right? So I don't know, not as thrilled about it as I used to be. If it would level off and our yield would stop, or our gain would stop falling 66%. But see, this one's brand spanking new. And one thing I've noticed about these Yield Max does it too. So it's not just Yield Boost. When they first get in, they way overvalue these things, and then they flush. And then they kind of get their footing, and then they start to go sideways or start to go up, and then their yield and their gain starts to level off. And if this will just stay, zero, we wouldn't care. 87% return is really nice. But as long as that's losing 66%, you have to start asking yourself, well, is it really worth it? And because it's exponentially compounding, it's still worth it, in my opinion, because you're still going to take it. I mean, others are going to pay you more, so it would be better off to be in something else. But if this would level off, which it is, it's leveling off. If we just go back, year to date, well, year to date's going to go all the way back there. Let's see if I can just go 3 months. See, that's leveled off, but the yield is leveled off too. So we're still only at 10%. It's not that great. It's not that great. So I'm a little disappointed. And it's good we found this out, right? I mean, beforehand, all we were looking at is the yield. And we're saying, yeah, the NAV's going down, but is it going down? You didn't know. We were shooting in the dark. Now we got this little tool and we can see that this thing is not that great. I mean, TSYY, if you go look at our little calculator over here, again, it's another perfect example. TSYY was the very top, right? TSYY, 140% yield. What does this not tell us? This little table here, it doesn't show us this. It doesn't show us this. Now, I've gone through all of them. I've gone through that whole table. I've gone through everything in that whole calculator, this whole table here, and I've looked them all up for you. And what we've done is going to go back over to Track and Trade, and I've done all the hard work for you. How do I get there? I'm always confused. All right, here we go. So here they are. These are the ones that are really performing for us. BITO. BITO. OARK. MSTY, HOOY, TSLY, CVNY, NVDA, SNOY, PLTY. Hope I'm not making any spelling errors. UL, ULTY, CONY, YBIT. All right. So this is our list of Yield Max funds. Oh, I did make a Coney. Is it CN? Which one did I screw up? Oh, I don't know if that's CVNY. CVNY? Yeah, I think it's that one. CVNY. Did we get Coney in here? I think Coney. CONY. There it is. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, I got them all. So that's the list right there of our very top ones, okay, in Track and Trade. So these are the ones that we're going to want to have in our portfolio. And you're like, oh, this is great, Lan. We got this. You've got these all into Track and Trade. Now, how do we trade these? Well, I still want to dollar cost average in based on the NAV. I still want to take into consideration, but I'm not going to trade. I'm not going to come in and trade NVDA, right? I'm not going to look at NVDA to decide when it's time to get into NVDA. I'm going to come in. I'm looking at NVDY. Actually, I am going to look at NVD. I typed that one wrong. NVDY is the one. And I am going to come and look at NVDA. NVDA is the one that I want to pay attention to on when it's time to get in. But when I get in, I'm not going to get in on NVDA. I'm going to get in on NVDY because it's going to give me the returns. It's going to give me the dividend returns that I can then compound back in. It's like the rent, right? So at the end of the year, I'm going to have 50 houses instead of just one house that's worth more money. That's why these dividends are so important. Yes, you could probably make more money just investing in NVDA this year, right? You're going to get a little bit higher return, but it didn't give you any income. So now you either have to sell your NVDA so that you can buy some more NVDA, but you're going to have to buy low, sell high, buy low, sell high, buy low, sell high. You're going to have to manage that yourself manually. Aidan Gray wrote an article about that in Pitt News Magazine. I think that was in the last month's issue. If you go read that article on Aidan Gray's whole concept of, well, you know, I can outperform YieldMax. He's like, I'm a good trader. I can outperform YieldMax, but he says I want it anyway. Why? Because it's very systematic and it just gives me the money and it pays me the dividends and the yields throughout the year, and it takes the load off my shoulder of having to make the decision of when I'm going to sell my shares, which is what I was talking about earlier, right? I decided to sell Palantir out. Ben's like, I'm not selling it out. Well, you're going to go down and I'm not. Yeah, but when are you going to get back in? Are you going to miss some dividends along the way? What are you sacrificing to get out? That's the question that Aidan Gray asked in his article. He's like, I can trade better than Palantir, PLTY. I can outperform them every time. But do I want to? Because it's a lot of stress and I have to constantly do all the work. I have to do all the rolling. I have to do all the laddering. I have to do all the work that it takes. And then what if I screw up once and, you know, I'm only one guy. They got a whole team of people doing it. I don't know. I think that these YieldMax funds, again, they're brand new. The oldest ones are only 2 years old, and I've been trading them for a whole year. I'm enamored with them. I love them. I think they're the neatest thing that's ever hit the stock market. They're back, reminds me of in the olden days, back when I was in Chicago, where we came out with single stock futures. And I was so excited about single stock futures, I couldn't stand it. I was so excited about those things. I was just like running around like a chicken with my head cut off, trying to tell everybody how great single stock futures were. And then they died because nobody would jump on the bandwagon with me. Now I feel like I'm doing the exact same thing. It's the exact same dance. I'm running around in circles, yelling and screaming at the top of my lungs, standing on top of out of the street, yelling, hey, look at how great these things are. Oh my gosh, these are the neatest things I've seen since I've been in the stock market for 40 years. And nobody will listen to me. It's like, their NAV goes down. I can make more money just trading the underlying. Okay, do that then. All right. Do what you want. The only question I have for you is, did you make 203% last year? And that's not even accurate because this is missing some of my other. Did you make $400,000? Are you going to on track to make $400,000 this year on a $400,000 investment? $448,000 is what I put in. And I'm on track to make $402,000 this year. And that's just on the ones that are active. And again, I pulled like 3 of them out that have already closed out because I'm reinvesting my dividends. So I've got free money that I pull out and I use that to make more money. And so it's not part of my initial investment. And those returns, when you have free money making free money, the return calculation on that is astronomical. I mean, it's like, it's the 7 wonders of the world that people don't participate in. This is the best way to participate in those 7 wonders of the world, anything I've ever found. This is the coolest thing since single stock futures. And to understand it, you really do have to have this program right here because it's the only program designed specifically to help you understand that model. And do I make any money if you buy this? No, I don't. If you go subscribe to Portfolio Matrix, I don't make a dime. Why? Because I don't own it. My son does. My son makes money, but I don't. I'm not. I helped him develop it. He and I worked on this together, but it's his company. I want to see my son do well, but I'm making money. I told him when we started building it, he says, I told him, I says, I'll help you build it. I'll help you pay for it. I'll help you develop it, but I don't want a penny of it. I don't want to own it. It's yours. I don't care. I make money from doing what the software was meant to do. I don't need to own the software. I make money because I'm trading Tesla. That's how I make my money now. I don't care about your software. I want to have it for myself. I want to be able to use it. Now, if you want it, great. Go buy it. It's got bugs in it right now. It's brand new. But you can get in. At least you can use this little tool. Now, on Thursday, I want to show you another feature, which is this little tool right here, which is going to absolutely blow you away. This is another tool that's going to freak you out. Oh my gosh, am I excited about showing you this tool. So I can't wait. I'm going to show you this tool. You're going to be really excited about it. And then we're going to go through and we're going to create our dream portfolio. And the software will actually tell you how much money you should put in each one. And I'm going to show you why. It's so cool. This is so cool. Thursday morning, bright and early. Tomorrow's Wednesday, so we're going to do day trading power hour. All right, so we got to go do some day trading so that we have money that we can put in here. Got to get your money from somewhere. You can either go work at a gas station if you want. That works too. Or McDonald's. Or, I don't know, maybe you're a doctor and you fix broken arms. However you want to get your money so that you can put it in here and invest it. But tomorrow afternoon at 1 o'clock, we're going to day trade, and that's how I get money, so I can put that money in here. All right, I'll show you how we're going to go do that. So join me tomorrow afternoon, 1 o'clock in the afternoon, so you can day trade with me. And we'll get some money over there, and we'll come and put it over here. And I'm going to show you the coolest damn little calculator you've ever seen in your life. Okay, I'm going to show you how BlackRock decides where they put their money. All right, guys, that's it. That's all I got for you today. And if you have any questions, please let me know. And I'm not going to keep you here any longer. We're just going to cut it right here. All right, guys, you take care. We'll see you bright and early tomorrow. Bright and early. We'll see you tomorrow afternoon, 1 o'clock. Do a little day trading bright and early Thursday morning to continue the conversation here in Portfolio Matrix.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.